Working Man Investor. Today's video, what's going on in the bond market and why it's critical that you're paying attention. So the bond market is just a financial marketplace where debt securities, such as the U.S. Treasury, are traded. Investors watch the bond market very closely because it is a great tool for determining the health of the overall economy. So just a quick background on Treasuries. When they go to auction, a bond's yield, it's just the interest rate. So when they go to auction, if there's plenty of people bidding on the treasuries, what happens is the treasuries go up. They're more expensive to buy, but the yield, the interest rate goes down. However, if you get in a situation where you have fewer bidders for bonds, the bonds will get cheaper and the interest rate, the yield goes up to try to attract more people to the auction and to sell the treasuries. So normally when the stock market plunges, investors are going to flock to U.S. Treasuries because the U.S. Treasuries are considered the safest investment in the world because they're backed by the United States government. And the United States government has never defaulted and not paid back their debt on the Treasury. So when this happens, the dollar usually strengthens. So when the market gets volatile and people are flocking into U.S. Treasury, the dollar almost always gets stronger. But that didn't happen last week. Instead, the dollar got weaker and the Treasury rates rose. This isn't what's supposed to happen when you're the reserve currency of the world. When interest rates go up, the dollar should have gotten stronger. That's the way it normally works. We normally see currencies getting weaker when interest rates rise in third world countries. We don't see it in the United States very often. This is why I'm so concerned by it. This is because in these third world countries, people are afraid of what's coming, and they're moving their investments out of that country's currency into more solid assets such as gold, silver, crypto, things like that. The fact that the dollar got weaker when rates rose is a concern for multiple reasons. One being the United States needs interest rates on our treasuries to be lower because this year we have to refinance 25% of our debt, which happens to be $9 trillion of the $36 trillion that we owe. This is because Janet Yellen, the former Treasury Secretary, made a big mistake when she refinanced the debt a few years ago on short-term notes. The reason that she did that, it could be for a multitude of reasons. One, maybe she just didn't know. Maybe she just assumed that the interest rates were going to stay low. But it also could be a strategy that helped keep the interest rates artificially low. But it could backfire now because over the next 6 to 9 months, we have $9 trillion coming due that we have to refinance. And we refinance this debt through U.S. Treasuries in auction. We sell it to foreign nations, to citizens that are investors. It's how we borrow money. And when the interest rates are up, it's more expensive to service that debt. Just like your mortgage. Think about your own mortgage. It's the exact same principle. When you're looking to buy a house and interest rates are currently sitting at about 7%, it keeps some people on the sidelines from buying a house. And a lot of people are looking back 5 years ago when you could have got an interest rate for 2.5% and kicking yourself because the payment is less. U.S. Treasuries are the same way. As the Treasury interest yield is going up, our debt is more expensive. Same with your mortgage. That's why you see people refinance. People that are buying a house now at roughly 7%, if next year interest rates are 4.5%, what do? They're going to refinance. Cheaper debt service. So why are bonds yields going up? And is the United States still the reserve currency of the world? Is some of the questions I get asked. Yes, we're still the reserve currency of the world. I don't see a single individual country's currency that's going to be able to take that from us anytime soon. But what's interesting, if you look back at charts into 2016, we were 65% of global transactions were settled in the dollar. As of today, it's down to 58%. And if you push it back 25 years ago to 2000, 72% of transactions in the global economy were settled in dollars to, like I said, 58% today. So who are we losing ground as the reserve currency of the world to? My initial instinct was the euro, so I went and I checked. In 2008, the euro was used in 28% of global transactions. Today, it's 20%. So the answer is it's not a single currency. But where we are, it's basically a basket of currencies. So the Japan yen, the Canadian dollar, the Swiss franc, different foreign countries' currency is being used more often than the dollar to settle the transaction. So that's where we're losing our reserve currency status to slowly. It's not an individual one currency, it's a basket of currencies. So why are governments losing faith in us? Part of it is our physical irresponsibility. Our government spends way too much money. The other part, we have a debt crisis now. You heard Jerome Powell say last year that our deficit at the time was $32 trillion, not sustainable. We're okay now, but we have to quit spending so much money. And the third reason, and the biggest reason right now, are President Trump's tariffs. They're causing countries to lose faith in the United States. So what happens when he sets tariffs up is, other countries don't hold U.S. dollars necessarily. What they hold are U.S. Treasuries. Tariffs are forcing countries to set up other trade blocs or trade with other countries and trade less with the United States. This means they need fewer dollars, fewer treasuries. So this is causing them to sell their treasuries. This in turn crashes the treasury market and forces the yield up. Anything else? Remember what I said. If you got all these countries now dumping treasuries, and some wealthy Asian businessmen are holding treasuries, they're selling the treasuries now to get money for gold. But when you have all these treasuries coming into the market and you don't have the buyers for it, the price of the treasury goes down and the yield goes up. The interest rate goes up. So it's back to debt service. This is the problem. So the higher the interest rates go, the more expensive it's going to be for us to refinance that $9 trillion that we have to refinance over the next 6 to 9 months. This is the real reason why President Trump suspended his tariffs for 90 days. Also, why does the 10-year Treasury, because that's like the benchmark, why does that matter so much to us? The 10-year Treasury yield matters to our banks because it's what they look at to set the retail rate off of that 10-year Treasury. So what this means is, again, mortgage rates are going to go up. Mortgage-backed securities are considered more risky than U.S. Treasuries, but they trade for the same type of customer. The same type of customer that buys Treasuries will often buy mortgage-backed securities. But since mortgage-backed securities are more risky than Treasuries, they often carry a higher interest rate, normally 2 to 2.5% higher than Treasuries. So when mortgage-backed securities go up, interest rate go up, mortgage rates for homes also go up. That's why people say if you want to watch our mortgage rates, don't watch what the federal funds rate is. And if the Fed's cut interest rates, watch the 10-year Treasury. But the banks use the 10-year Treasury to base everything off. So not only our mortgage rates are going to get more expensive, our credit card rates. So those of you that are in credit card debt, start paying off your credit card debt now. That's the best investment you could make. Because if the 10-year Treasury continues to go up, your credit card interest rates are going to go up. And business loans are going to go up. Higher rates reduces borrowing. Now that's bad because one person's debt is another person's income. Therefore, as interest rates to borrow money go up, it's going to be less businesses taking out loans. Less businesses taking out loans means they're not as productive, they're not doing as much, they're not hiring as many people, and they're not promoting, they're not giving raises. It hurts the economy overall. So this is why it's so important to be watching the bond market. Remember, interest rates are just the cost of money. The higher the interest rate, the more expensive it is to borrow. The United States sells its debts to other countries. It's a privilege that we have as the reserve currency of the world. We sell our debt in the form of treasuries. They pay for it. We take that money in and we set up our infrastructure, our welfare systems, all the things that help us to have good lives. But after the time's up, we have to repay it. We pay it and they usually take that money back and they buy more treasuries. You want the interest rate as low as you can to service the debt. Since we're currently $36 trillion in debt as of the making of this video, and as I've said several times here now, because it's so important, $9 trillion this year have to be refinanced through U.S. Treasuries. We need this interest rate to be as low as possible, or it's going to get really expensive and damage our economy. So watch the bond market. When you see the bond market throwing a fit, be leery, because that's where they say smart money goes. It's in the bond market. So always pay attention to that 10-year Treasury, and it's just a good idea to keep an eye on the bond rate. You don't have to do it every day, but I would do it at least once a week. So that's what I got for you. Working man investor, keep grinding, people.